Welcome to this chapter again for the last time, capital market, secondary market. Now we will learn one important thing, margin trading. Now what is margin trading? Good for people like you. If somebody can lend you money, suppose you have, let us say, rupees 80,000 with you, okay? Market price of share is suppose 10 rupees. So how many shares you can buy? Number of shares you can buy is 8,000. This is your own money. But some banks or some brokers, they lend you money for purchasing the share. They lend money. That is called margin trading. Now, suppose you want to buy 20,000 shares. So to buy 20,000 shares, what will happen? Market price is 10. You need 2 lakh rupees because you are expecting that the share price may rise. But you have only 80,000. So remaining amount 1,20,000 can be financed by the bank with whom you have that account, or by the broker with whom you have that account. Okay. Now suppose the share price increases by 50%. Share price increases by 50%. What will be your gain? Using this borrowed money and own money, total 80,000 plus 1,20,000, 2 lakh is the amount invested in the share market, gain will be 1 lakh rupees. Had you not used this margin trading facility, gain in the absence of margin trading. Yes, now you can answer. Gain in the absence of margin trading. 80,000 only you could have purchased. 50% appreciation, 40,000. So instead of 40,000, you will earn a profit of 1 lakh, 60,000 more. Because bank has lent you money, and because you have you borrowed money from the bank, you have to pay some interest also. But in any case, your return will be very, very high. Why banks lend you money? Because banks keep the securities as collateral. Bank keep the securities as collateral. In case if you fail to repay, then the bank will sell those shares and recover their money. Then bank normally will not lend you entire 100% of the money also. Will bank lend you 2 lakh rupees to buy the share? No. You should have your own involvement also, your own stake also. So if you are willing to say invest, let's say 80,000, bank will also lend you about 80,000 or somewhere nearby, depending upon the policy of the bank. So banks may give you a margin trading facility of say 50%, 100%, okay, whatever. But there is a huge risk to the bank also, because if the share price fall down suddenly, the bank will give a margin call to the investor. What it is called? Margin call. Margin call means bank will ask, suppose the price of the share falls to 8 rupees or 7 rupees or 5 rupees, means bank's collateral value has gone down. So banks gives margin call, and you have to pay that margin call or give some other collateral. If you don't, then the bank can sell the shares. So that is margin trading. Good for investor. He can take a position much more than the value or the amount that he has. If he has 80,000, he is taking a position of 2 lakh rupees. Risk also, because if the prices fall, he will have a higher loss. Okay. So brokers, bankers can allow you this facility. Now I am expecting a question on this margin trading. Margin trading is a facility given to the investors in which they can invest in share by part financing from the bank. Investors can provide some amount of money from their pocket to invest in shares, and the rest of the amount will be financed by the bank. Margin trading permit investors to buy shares by providing 40% of the total value as margin. This is indicative only. Indicative means example. While 60% can be borrowed from the banks, it can be reverse also. That is, you have to invest 60% of the value of share. The bank will give you, say, 40%. For example, an investor wants to buy 20,000 shares. I have used the same figures to explain. Easy for you to understand. Investor wants to buy 20,000 shares worth rupees 2 lakh. Price of one share is rupees 10. But he can invest only rupees 80,000 from his own pocket. He wants to buy shares of 2 lakh. He has only 80,000 rupees. So under margin trading, he can buy as many as 20,000 share worth rupees 2 lakh from his broker by paying rupees 80,000 as margin and borrowing rupees 1,20,000 from a bank through his broker. So this is called margin trading. Using borrowed money, putting some own money and purchasing the shares. The broker pledges 20,000 shares with the bank. Understand? The bank will keep these 20,000 shares as collateral because bank needs some safety. The bank has a collateral of 2 lakh backing a loan of 1,20,000. In case if you are using equity share as a collateral, generally the loan amount will be much lower than the value of the share because there is a risk that the share prices can fall down. Now suppose the market price of the share moves upward to rupees 15. From 10 to 15 means 50% jump. With the help of the facility of margin trading, the shareholder can sell his entire holding of 20,000 share and pocket a gain of rupees 1 lakh. That 1 lakh calculation you understood? 50% gain from 10 rupees to 15 rupees is 50% appreciation. But there is a huge risk also, which we'll discuss. Conversely, if he hadn't availed the facility of margin trading, he would have been able to sell only 8,000 share and pocketed a gain of rupees 40,000 only. The reason is that he would have purchased only 8,000 share because of the paucity of funds. Paucity means shortage. Okay. But this margin trading is very risky. It is similar to, you can say, future trading. In future also, we deposit initial margin which ranges from 5 to 15% of the value of the stock, and then we take the position. But if the prices fall, you can suffer a heavy loss also. On the other hand, if the market price of the share fall below rupees 10, the bank will give a margin call. The bank will give a margin call. There are some movies also made with this name called margin call. Have you seen? No. Okay. Under which the investor will have to furnish additional funds or securities for the broker to pass on to the bank. Margin trading is beneficial for both investor and the bank. Investor is able to take a higher position, bigger position, and banks usually charge a high rate of interest because the risk is also high. However, banks have to evolve a suitable risk management mechanism to safeguard the loans given by them against collateral of securities. So RBI is telling the banks, be careful while doing margin financing because the risk is high. Ramalingam Raju long back, Satyam case. Satyam saga started with this only, because he has taken loan against shares and Satyam share prices had gone down substantially. And then he was not able to submit additional funds or additional securities. So then the bank said, since you are not able to furnish additional shares or securities, we are going to sell your shares. And it is not just few hundred shares, few thousand shares, it is lakhs of shares pledged. So therefore that whole story came out. Okay. So that was what I have read was due to this use of loan against share by the Raju and his team. Because prices had gone down. So bank will ask you to pay the difference again. Okay. And if you are not able to pay, bank will sell. So selling pressure will increase. More decrease in the share price. More margin call. So that cycle will start. In some way it provides a facility to investor to borrow money from the bank and invest it in the stock market. So I will request you, do this only if you can afford to take the risk. But not all banks will allow this, not all investors are allowed this also. Indian debt market. A brief discussion about Indian debt market. Many paragraphs will be repeated here. So those paragraphs which are repetition, I will go through it fast. Okay. So first paragraph number 1. Point number 1, what is a debt market? Debt market refers to financial market where investors buy and sell debt securities, mostly in the form of bonds. Debt market is boring for a retail investor, okay, because we normally do not participate. But debt market is bigger than the share market because corporates, banks, financial institutions, mutual fund, RBI, government, they are involved in the debt trading. So therefore this is also a big market, but this is a wholesale market. This is like a wholesale market. You don't buy one debenture or two debenture. So this is a very big market. State Bank of India in its balance sheet will have bonds of 10,000 crore rupees. Okay. Foreign institutional investors invest thousands of crores of rupees in the debt market because India offers a high rate of interest. They can borrow from their country at a low rate of interest, invest here at a higher rate of interest. Subject to, of course, exchange rate volatility because sometimes they may lose because exchange rate may rise. What are the example of debt securities or fixed income securities? Second point, the example of debt securities or fixed income securities are the bonds issued by central and state government. Okay, in your income tax also there are some bonds, are relief, national relief bond. No, national highway bond, rural electrification bond. Then bonds are also issued by municipal corporations. Okay, to raise funds for their local area development. Bonds are issued by government bodies. So private sector bank, public sector bonds. And of course bonds are issued by private entities and financial institutions like banks and corporates. Next is, what are the benefits of debt market? Next few points I have converted into heading. What are the benefits of debt market? First is, these markets are important source of funds. It's written in the second line of this heading, paragraph. These markets are important source of funds, especially in a developing country like India. First benefit. Because in India, if you ask investor to invest in share market, retail investors would be reluctant. CA final student in our batch is not investing. In spite of reading so much of corporate finance. Imagine an ordinary citizen of the country, he will not invest in the share market. So where he invests? He invests in bond market. He thinks that these are safe. Government is able to raise funds. Corporates are able to raise funds. It is vital to the sustained growth of any economy since they offer efficient mobilization and allocation of financial resources. Through debt market, savings are converted into productive use. Those who can save will lend funds to those who need funds. So that is called sustained growth. Okay, mobilization of saving. And then third is are used to finance development activities undertaken by the government. Development or non-development, but the funds are used by the government. Okay. Some of them are used to finance the foreign trips also of our ministers. But that you don't have to write. Some of them are used to build statues also. But that you don't have to write. Okay. And they also aid in managing the liquidity in the economy. Liquidity means those areas which have surplus, the money is transferred to those areas which have deficit. So when you are investing in a bank FD or a government bond, what you are doing? You have surplus liquidity, that is why you are investing, and through banks, financial institution, it goes to those areas which need funds for whatever development, infrastructure, etc. Next line, debt market is said to be a useful source of finance for Government of India. In fact, Government of India is the biggest borrower. You may not know, but they are into debt trap now. What is debt trap? If you have to pay interest, you have to borrow money to pay the interest. So that means every year they are just borrowing and more borrowing to pay more and more interest of the earlier borrowing. Most of the state governments are into debt trap. Currently, Indian economy has a deficit of 4.5% of GDP. Then how do you finance it? Mainly through debt funding from different sources. Is it right? In fact, this was a question which in my IAS interview they had asked me, how does Indian government does its debt financing? I said borrowing or printing money. But printing of money, RBI will not allow you to print as much as you can. There is a limit on that. There are calculations they do. Only if you print money, it will cause inflation. Is it right? So therefore, what is the last option with the government if after all efforts fail? Borrow. Borrowing is the last choice. Printing of money is not the last choice. Many people think that is the balancing figure. The balancing figure is borrowing. First, they will tax you as much as you can. Unless there is an internal revolt, till that time they will tax you. Then they will ask the PSUs to pay dividend. Whatever maximum they can extract as dividend from the public sector unit, they will extract. Then they will try to sell some PSU also and raise money. Okay. Then they will ask RBI to print a note also. And finally, if nothing works, the balancing figure is borrowing. The government securities form a major part of the Indian debt market. Look at the balance sheet of banks in India. You will find there in investment heading, investment in this bond, that bond, most of them issued by government. The outstanding debt of Indian government forms, my God, 39.5% of the GDP, which is at par with that of other developing and developed countries. Everybody is borrowing. So therefore we are at par with other countries, but that is not a very good news. In fact, in most of the governments are big borrowers because they really don't care. They have to be there for 5 years only. Whatever they want to do, they will do. The next government will repay them. So you don't worry. You borrow. The investor in the debt market also favor government securities because it is safe. Debt market can be divided into two categories. One is GSEC, means government security. So this word GSEC will be used in the note somewhere. GSEC or gilt securities. Spelling of gilt is GILT. GSEC or gilt securities okay, and bond market. Who issues the bond? Other than government bodies. So corporations. Now next is government securities. Some features of government securities. It consists of central and state government securities. It means loans are taken by central and state government. So government is the borrower and it is the most dominant category in the Indian debt market. For a fill in the blanks question or a true false MCQ, dash is the most important category in the Indian debt market. So you have to write government securities, not corporate bonds, debenture, bank FD, okay, commercial paper. These are the options they might give you. Bond market. What is bond market? It consists of debentures, bonds issued by financial institutions, corporates and public sector units. These bonds are issued to meet the financial requirement at a fixed cost and hence remove uncertainty in financial costs. Now here also many times they use the word bond and many times they use the word debenture. How do you distinguish them? When government agency, somewhere government agency is involved, government or government agency, we call it bond. And whenever a private sector entity is involved, same instrument, 8% coupon rate, 5-year maturity, 1000 rupees face value, issued by a private sector entity, then we call it debenture. The advantage of bonds and debenture, as you know, is a fixed rate of interest in many cases. So companies knows what they are paying for borrowing. Not only that, in India, the interest is a tax deductible expenditure also. Corporate debt market can be divided into primary market and secondary market, like your share market. Primary market is the market for first issue. In the primary market, corporate debt is issued, right, by private placement. Corporate debt is issued via private placement, like corporate bonds placed with wholesale investors. Who are the wholesale investors who buy these corporate bonds? Banks, financial institutions and mutual funds. Few paragraphs I have removed because a lot of statistics was involved. And secondary market for corporate debt is available on platforms offered by various exchanges in the country. So there is a secondary market for corporate bonds also, where they are traded. You can buy and sell. As the market rate of interest changes, their value also change. That you have learnt in the bond valuation chapter in SFM. The reason why that bond value is changing is there is a secondary market for that. If there is no trading in the bond, it will ultimately be redeemed at a face value only. So secondary debt market in India is wholesale debt market and retail debt market. Now wholesale debt market comprise of investors like individual, pension fund, private trust, NBFC and other legal entities. Okay. So even you can participate in debt market. Some mistake is there. It is for retail debt market. Oh, it's a repetition. Okay, I'll just comprise of investors like banks, financial institutions, RBI, insurance companies. These are the big players because they have huge amount of money to invest. Then mutual funds, there are debt funds which invest in this debt market, and corporates, financial, foreign institutional investors. These are wholesale debt market. Big player, they buy in bulk. NBFC also buys in bulk. You can, because somebody can come under both categories also. So even I was surprised. And retail debt market, individuals, pension funds. Now you can put pension fund in wholesale also because sometimes they may buy in bulk. Private trust, NBFC. This also depends on their volume, can be in retail segment or wholesale segment, and other legal entities. Again, it depends. They might buy at less value also. These players buy in terms of crores and thousands of crores of rupees. Okay. Whereas they may not invest crores, thousands of crores of rupees in one go. So you can put as wholesale also. That means he can come under wholesale category also. But their volume will be much lower than, say, RBI or financial institution. So that is why the institute thinks they should be kept under retail debt category. Two types of transactions takes place in the debt market. One is the direct transaction between wholesale market participant. So directly SBI will purchase from, say, other bank or RBI, or there can be transaction routed through brokers, broker intermediated transactions. In broker intermediated transaction, brokers undertake dealing for banks, institutions or other entities. In fact, this is also a big market. You can become broker of debt security also, because the volume is very high, and then you can help in arranging the deals. Direct transaction, these account for roughly 25% of the wholesale market volume, which means 75% of the market is dominated by brokers. Yes, I have some friends who are actually helping corporates to purchase debt bond from other entities, and they do the intermediation. They get 0.1%, 0.2% as commission, but that is also huge. 0.1% of 100 crore is again a big number. Is it right? Corporate treasuries deal in bonds, and there are some brokers who arrange for the deals. So maybe one day if you join corporate treasury, then you will require retail brokers for bonds also. Now, last paragraph. Why do we need a debt market? Actually, in paragraph 8 also we had a discussion. There is a repetition, so I'll just quickly read it. Institute has repeated it, I have also repeated. Debt market is needed for sustained growth of any economy, since they offer efficient mobilization and allocation of financial resources. Second, this was already discussed, to finance development activities undertaken by the government, to aid in managing the liquidity in the economy, allow the government to reduce its dependence on external sources of funding. So government can borrow in-house only. Why to go to USA? That is the ultimate last option. Okay. And the last is, don't write it. Modi ji will get angry. Reduces the pressure on institutional financing to fund public sector or private sector projects. So now many projects are financed through issue of bonds. Whenever a highway has to be constructed, they will issue bonds, and that money will be used for funding that highway projects. So this way they don't have to depend on any bank or financial institution. They are borrowing from public at large. This chapter is over.